You're listening to the Brinkman Report, bringing you the latest insights into multifamily investments in the Intermountain West. Join Kevin Brinkman, founder and chief executive officer of Brinkman Real Estate, as he talks to industry experts in every facet of the business to go beyond the headlines and dig into the data. Kevin will welcome leaders in capital markets, acquisitions, investment, asset management, and more to discuss real-time market trends as well as first-hand experiences in the industry, focusing on the unique dynamics of multifamily investments in the Mountain States. Visit thebrinkmanreport.com to subscribe and receive monthly episodes straight to your inbox.
Welcome to the first podcast of the Brinkman Report. We are excited to kick this off today, and we will be bringing it to you every month moving forward. A focus of multifamily investment and acquisitions through the Mountain West. We plan on interviewing and bringing on really experts in the field, from capital markets to brokers to economists, every month moving forward. And hopefully that will add to your knowledge set for how you're looking at the market that we're in. Today, we are happy to have Dan Metzger. He is the Chief Operating Officer with us here at Brinkman Real Estate and also Chair of NIOP Colorado. Thanks for joining, Dan. Would you mind starting and letting all the listeners know a little bit about your background, your role at Brinkman Real Estate, and how you spend your time?
Sure. I went to school at the University of Wisconsin, studied real estate there. I've been in the business for about 26 years now. I've got a pretty diverse background in real estate development, asset management, and real estate finance, really across multiple product types. I've also worked for a wide range of firms, a national REIT, a regional development firm, real estate private equity group, amongst others. So I've been at Brinkman now for 2 years, and I get to draw on that diverse background to get involved in a lot of different areas of the organization. But my primary role is certainly overseeing the performance of our existing assets. So that includes Brinkman's asset management team, as well as we do have an in-house commercial property management group.
Perfect. Well, appreciate joining today. We're going to spend a lot of the time more on the midterm outlook for multifamily, specifically in the Intermountain West. And I'm going to give a summary of that now, but then we're going to start with really what we're experiencing here in 2024. And a lot of that is focused on operations, which Dan can go into a little bit more detail on. So the midterm outlook, we feel, is very strong on the investment side, especially when you look at supply and demand. We're seeing new starts down about 70% from the highs. So that's 70% down on multifamily. We're already probably around 5 million housing units short. So there's already a shortage of supply even before this down tick in new starts. As we've seen that the consumer is still strong and thus our tenant is still strong, a lot of that's due to a tight labor market. One of the surprises we've seen in the last 12 months is the huge increase in net immigration that we'll go into a little bit more. And we all know how unaffordable the for sale market is, and that's pushing a lot of folks to be renters and not owners. So we feel like that leads to strong demand, growing rents, high occupancy in 2025 and beyond. And we'll get into that a little more granular here in a minute. But first, we wanted to start with the short-term outlook, because there are definitely headwinds that we're experiencing in the real estate market in general and in multifamily. A lot of that is due to the supply that's being absorbed right now and a lot of these inflationary pressures that we're seeing. So Dan, if I could first ask you, what are you experiencing with our portfolio? What are the trends you're seeing in operating expenses?
Operating expenses, well, they're going way down across the board, right?
Yeah, all good.
No, of course not. I would say we are starting to see some expenses normalizing, kind of back more to that 3% growth. Obviously, the two things that really stand out as much higher than that, and no surprise, are real estate taxes and insurance. So on the real estate tax side, not only did our valuations, that we received from the assessors go up, but we've certainly found that assessors have gotten much more sophisticated, more aggressive in how they approach our appeals. So our appeals have been much more challenging than they have in years past. On the insurance side, it's candidly, it's a mess. Premiums continue to rise. The carrier underwriting has gotten more difficult. We're looking into some creative options to try to reduce our expenses, but insurance is definitely a big bogey. So overall, operating expenses are definitely cutting into NOI growth, and that's a real challenge for us and pretty much everyone in the industry.
Yep, yep, yep. I hear that a lot, especially in Texas, where a lot of their tax burden is on property taxes. I've heard that's especially challenging there, and thankfully that's not as much so in the markets that we're in. Also, we know that labor has been difficult, ever since COVID, and how such a tight labor market we've had. How has that played out just for staffing at the property level?
Yeah, it's gotten better for sure. We're not seeing the big game of musical chairs that we saw, the last few years where an employee would just go, to a competitor for more money. So I'd say wages are stabilizing, but staffing turnover just remains a big challenge for us. I would say being a property manager or a maintenance person in a multifamily, it's simply just a more difficult job than it was pre-pandemic. We've seen high turnover from people getting burnt out and also just for disciplinary reasons being let go. So we've seen savings in our payroll category at quite a few of our assets so far this year, but unfortunately it's been typically because we've had open positions there and
Yep,
not
yep,
due to any wage savings.
yep. So big picture, as I see 2024, and a lot of people are dealing with is all different types of businesses, just the inflationary factor, particularly in real estate, property taxes, insurance. And also we have a lot of new deliveries that we're competing with currently that is making our occupancy and demand a little bit softer than usual. And we're going to go into that in a little bit more detail here in a minute. I wanted to take a quick step back and on interest rates, just we're in a very interest rate sensitive industry in real estate. So looking at the Fed dot plot is always interesting. Going into this year, the market was pricing in almost 7 interest rate cuts, well below where the Fed governors were telling us. And then fast forward, here we are today, and the market is actually more conservative than where the current dot plot is. So, what we're hearing from our investors is that, we're really not planning on any Fed rate cuts this year and orientating our investment thesis and our strategy on capital markets with that. If we get surprised and there is one cut this year, great, but we don't want to be surprised the other way. So, Dan, of course, I want to put you on the spot. What's your prediction on the first Fed funds rate cut?
Well, so first I would say I'm not an expert in Fed interest rates. However, I tend to be more of a pessimist, a glass half empty sort of guy. I see the first cut coming maybe late Q4, early Q1, and I tend to see it more, stabilizing at that 4% range, like this graph is showing.
So I know so much of the conversation is that first Fed cut. I think the conversation is going to go to really where that neutral long-term rate is. The most recent dot plot still shows it at 2.5%. That's where the Fed's going to get to long-term, which if that was the case, that would be incredible for real estate. The market is pricing that it comes down to 4% for long-term neutral rate. So that's that market higher for longer. And so that's 150 bips difference. So at some point, there's going to be a reckoning there, and we'll see. We think it's probably going to end up in the middle, someplace probably in the closer to 3. But that's part of our jobs to make sure that no matter what happens in the capital markets, that we can execute towards our business plan. So with staying on the debt conversation, as you know, we are 100% focused on multifamily acquisitions through the Mountain West. We've heard a lot of conversations of the wall of maturities, a lot of this debt that is coming due. In 2024, it's about 1 trillion coming due. About 300 billion of that was extended from previous years. So there is that extend and pretend from lenders currently. So we think that will continue to go forward and be pushed forward. But at the same time, at some point, banks are going to start digging their heels in the sand. And I think that's what's going to cause a little bit more transaction volume. And that's what we're really out there looking for, are some of these motivated sellers in the markets that we're in. So again, from a high level, we believe it's going to be a typical real estate cycle. And that's the expansion, which we're coming out of, oversupply, which we believe we're in, going to a low of recession, and then back into recovery. And so we really, investing 101 is buy low, sell high. Yeah, so we follow the market cycle quadrants model that Professor Mueller uses at the University of Denver. And he's really forecasting and showing mostly all multifamily markets in either hyper supply or recession and moving towards recovery. So I wanted to use this as a point to talk about the supply in the market. So Dan, would you mind sharing what you're seeing out in our markets with respect to occupancy and asking rates?
Sure. So as it relates to occupancy, we've seen a slight dip over the last 12 months. Right now, we're around 93% occupied in our portfolio. That is skewed slightly downward, though, by a couple of assets that are finishing up in lease up right now. Yeah, like you said, though, you really can't talk occupancy without talking asking rates, because they're tied so closely together. As far as rental rates are concerned, this is very, very market specific, just whether or not, rents are going up or down. We've had some of our markets that are, in higher supply. Take a Salt Lake, for example. We've definitely seen rents slide there, slightly backwards over the last 12 months. Another market that is going the other direction, though, is something like a Kalispell, Montana, where there's much fewer products come into the market over the last year, and we've still seen solid growth there. So overall, in the portfolio, rents have remained relatively steady, I would say, either up or down a couple percentage points either way.
Okay, perfect. Yeah, so as an investment acquisition company, what we're really looking at is these markets that we think are bottoming out and that are going to start into recovery. And what we always think of this Warren Buffett quote, be fearful when others are greedy, and be greedy when others are fearful. And we believe, a couple of years ago at the top of the market, when people were in Phoenix bidding to a 3.25 cap, that we were in these smaller growth markets paying closer to a 5 cap. And then a lot of groups are on the sidelines now, when this is the time that we should be in. And we're starting to see the very beginning of this. You probably saw the headline from Blackstone making the 10 billion acquisition 2 weeks ago. And so we think that's the beginning of some of these institutional groups coming back in. But we think we have a great window here of 12, 18, maybe 24 months where there's still a lot of buyers on the sideline, and that we're able to come in and find some good opportunities. And why we think now is the time is because we believe there is a lot of dry powder on the sideline. Thankfully, a lot of it's sitting there and waiting, but there is almost 250 billion already raised in vehicles targeting commercial real estate. And then also really unprecedented amount of dry powder just in money market accounts. It's almost up to $6.5 trillion. Historical average is around 3. So we're about twice as much just in money market accounts. And then in just bank deposits, we're up to almost 4 trillion. So if you take just those two together, we're over 10 trillion sitting there. And then on the short end of the treasury curve, there's another probably 2 trillion. And so the saying, a lot of people have heard is, T-bill and chill, where they're able to get 4 or 5% right now in short-term treasuries and wait. But that's just, if you put those three together of money market accounts, bank accounts, and short-term treasuries, that's over $12.5 trillion. So we feel like there is going to be stress, going to distress in real estate, but there's also a lot of capital out there. And so that's why we believe now is the time to go find these opportunities before a lot of this capital is on the sideline. I wanted to hit a couple other details on why we think multifamily is still the right investment, especially in the Mountain West. Undersupply is still at record levels, and that is just growing, particularly because starts are down 70% from the peak. And we believe that moving forward, they might be down 85 to 90%. There's just going to be really few starts, construction starts multifamily in the next 12 months. So, Dan, can I ask your perspective here on deliveries? How are these projects going from a lease up and in concessions for those projects getting delivered right now?
Yeah, sure. Again, this has really been very market specific. We've had competitive projects in our markets that have leased up without having significant concessions, but those are in markets where supplies remain in check. And obviously in those instances, it has not had a major impact on us. But in some markets with heavier supply, we've seen some developers get very aggressive just to put heads in beds. They've got higher interest rates are increasing their debt service, so therefore they're just doing everything they can to cover their monthly nut. So in the most extreme case, I can think of one market where we've seen 6 to 8 weeks free, but most of our markets are in the 2 to 4 weeks of concessions.
Great. Yeah, I think from a strategic level, we were focused on the markets that were not getting overbuilt. And so these are made the smaller markets where the larger institutional groups couldn't come in and build like a 400 unit tower. And so those places, like we're sitting in Denver right now, where some of those projects are in Rhino, and those will be delivered. They'll still be delivered over the next 12, 18 months, because those projects takes 3 to 4 years to deliver. A lot of the markets and submarkets we're in are mostly 3-story stick built, and those projects you can get through a lot quicker, call it 18 months, 24. So in the markets we're in, we're seeing a lot of the absorption take place in the deliveries this year, and then we believe there won't be many deliveries next year, compared to some of the bigger markets where you have these mid-rise and higher density projects, where those will continue into 25, maybe even 26. So some of those overbuilt markets are what we're going to be pivoting to moving forward. So you'll probably see that in us from places like Boise, more from Salt Lake, where we think there has been more deliveries and there will be more opportunities. The big demand surprise for last year was the 3.8 million in net immigration and population growth in the U.S. And majority of this was immigration. And independent of your political view on that, that was a reality, and that is going to be a demand driver in multifamily. Probably a lot start in Class C, moving Class C folks to B and to A and on. So I know it was a big concern of this delivery wave we've had this year, but the immigration and the population growth that we've experienced has absorbed a lot of that, which will be very beneficial for the industry. Housing is another thing that I think we should talk about in Denver specifically. Historic market supplies around 6 months. Right now it's only 2 months. So there's a huge shortage of housing, and also the affordability. Prices have gone exponential along with interest rates. We're in the 7s. So you compound those two things, and we just have historically the highest unaffordability that we've ever seen as a country. To afford the median home in the US right now, you need an income of 111,000, which is out of reach a lot of Americans. And so that's just going to increase more demand for rent housing in the markets we're in. And we've seen this particularly in the Mountain West. Average home in Colorado is 526,000. Utah is almost 500,000. Montana, Idaho, all over 400,000. So there's a huge amount of demand without as much for sale supply, which is just going to result in higher prices. And you couple that with job growth. And unfortunately, a lot of the markets we're in, we're seeing a great job growth. Utah, 11%, Idaho, 12%, Montana, 8.5% from March 2020. And so these are updated numbers of March of this year. I know a lot of the conversations were, how many people in the Zoom economy went up there is going to have to return to wherever they came from. And we haven't seen that yet. And even in these stats, as of March 2024, some of the highest growth in the country has been in these markets. So we are tracking that closely. And one other thing that we believe in the long term from a climate change perspective, that things will get hotter, that will get hotter in the south, and there will be a natural migration more to the cooler areas over time. We're talking over until 2050. And so we think that a lot of the markets we're in the Mountain West will be a benefactor of those changes. All right, to wrap up the market update, we're excited to be in 7 states, 22 markets now, and we look forward to the opportunities that lie ahead in the next 12 to 24 months, where we think there are going to be some great buying opportunities. One question I was thinking of for you, Dan, is that with housing getting more expensive, politicians are getting more involved, right? We saw that with inclusionary housing in Denver last year. We're seeing that with different kind of rent control in different markets. What have you seen from your involvement at NIUP and with our portfolio?
Yeah, so I'm the chapter president of NAP this year, and it is, candidly, this is a challenge for all of our members. The cost that goes associated with the requirements that they're implementing is just, it's way too much for the real estate community to handle. So we definitely are seeing the state and local governments getting more involved in this, and candidly, it's a problem for the real estate community.
Yeah, I always think that there's trade-offs with any public policy. You see that with inclusionary housing where things just get more expensive and a lot of developers just won't go into those markets. I think we are advocates for obtainable and affordable housing. The challenge is with some of these things that it does the opposite. We've experienced that very clearly in Boulder with when you have this increasing demand and no additional supply, just what values do. Average home in Boulder right now is over $1 million. So we spent a lot of time on that, looking at all the markets we're in, and some of those create a moat where we don't believe there's going to be a lot of new supply because of some of the, political requirements in the market. But we are very attuned to that and watching that very closely. Anything else, Dan, you think that'd be interesting to discuss?
Yeah, so one other thing we've seen across our portfolio, just anecdotally, is that just from a number of residents who are applying, we've seen an increase in the denials. So that's definitely something we've seen over the last, call it 6 months. And we've also just seen a slight uptick in delinquency in our portfolio. It's not a significant trend, definitely something we're keeping our eye on. I would just say the average renter just continues to pay more in housing, their automobile, insurance, food costs. So it definitely is eating into their savings. Kevin, I'd like to turn it on you for a second. Just I'm curious, what are you hearing from investors in your conversations with them?
Yeah, I think it's definitely uncertain times. We do have an election this year, so there's a lot of that noise and uncertainty. Geopolitical, we have funding for 3 conflict areas in Ukraine, Middle East, and in Taiwan. So that is something that, I probably haven't seen it in my lifetime. So a lot of the short-term money that need to be in and out in 3 to 5 years really is on the sidelines because of all that potential risk that's out there. You really would have to underwrite aggressive rent growth and cap rate compression, which really you can't have a lot of confidence in the next 3 years if you want to be in and out in 3 years. So those that are active can take a longer term approach. So we see that a lot of the family offices who could own real estate, multi-generational forever. And a lot of it's a basis play where if you can buy something for around 200,000 a unit, replacement costs are around 300,000. And there were comps 2 years ago at 400,000. I think you'll be happy with that purchase long term. So I think, we're really focused on like-minded investors who really have confidence in these markets at these the basis that we're coming in at, and that we're comfortable holding for, usually it's easily over 5 years, but probably more like 7 to 10. Well, thank you for joining today, Dan, and providing your insight and experience. Greatly
Glad to be here.
appreciate it.
Yeah.
And this is a wrap for our inaugural podcast of the Brinkman Report. You can find us on Spotify or thebrinkmanreport.com, and we will be getting new content to you every month. Thank you for joining.